Hello and welcome to this week's instalment of Nucleus Investment Insights. This week our attention turns to a review of the December 2019 national accounts, which are hot off the presses and offer a basis in which we can consider the forward impact of Australia's biggest ever fire season, combined with the emerging coronavirus crisis. Here to ask the question, is this the calm before the storm for the Australian economy? I'm joined by our Chief Economist, Leith Van Onselen. G'day, Leith.
G'day, Tim. Hello, everybody.
And of course, our Head of Investments, Damien Klassen. Hi, Damien.
Hi, Tim.
Fantastic. And just a quick reminder that before we get started, to subscribe on YouTube and click on the notification bell to be notified of when we go live or have a new webinar to watch. And of course, follow us on your preferred podcast platforms. So let's get into it. So the agenda today, we're going to be looking through the Q4 2019 national account results. We'll then be rolling into an outlook given the events of Q1 in 2020, and there's been plenty of events there. And then, of course, as always, we'll roll through into the investment implications and how we use these themes in the portfolios every day here at Nucleus Wealth and the MB Fund. So with no further ado, let's kick off. We've got the Australian economy growing by 0.5% in Q4, Leith.
Yeah, that's right, Tim. Now, the national accounts results for the December quarter came in a little bit stronger than expected, with the Australian economy growing by 0.5% in the December quarter and growing by 2.2% year on year. Now, that slightly beat analyst expectations, and the contributions to growth this quarter were, we got 0.2% from inventory, so basically firms and retailers, etc., got more stock in, which brings growth forward.
More stock that they didn't sell.
Yeah, sorry, that's right. More stock they didn't sell, which basically inflates growth. Inflated growth this quarter. We also got 0.2% contribution from household final consumption expenditure, a 0.1% contribution from net exports because imports actually fell, which you could see as another sign of weak domestic demand.
Yep.
And also we got a 0.1% contribution from government consumption, and those growth drivers were partly offset by a 0.2% decrease in private investment. We had quite a steep fall in capex over the December quarter. Now, the gross domestic product is basically the activity in the economy, which includes net exports. But often we like to exclude net exports to give you an idea about how the actual what the activity within the economy is.
Yep.
And how spending's going in the Australian economy. So a better measure of I guess what we all feel as consumers and living in the Australian economy is domestic final demand, which is which you've got in the next chart. Now the gross domestic product measures basically the strength of the economy and includes net exports in that figure. But a better gauge of how the domestic Australian economy is going is actually exclude net exports and just look at final demand, which basically is the sum of household consumption, government consumption, private investment and government investment. Mm-hmm. And I've put the annual growth rates there for across all the states and the Australian government and the nation as a whole. And state final demand actually lagged GDP growth and only grew by 1.3% in 2019, which is actually below population growth.
Wow!
So it's actually final demand actually fell by 0.2% when you adjust for population growth, and over the December quarter only grew by 0.1% versus 0.5% in of GDP. So while the overall economy looks like it grew at a reasonable rate, when you actually break it down and look at the actual activity within the economy and you exclude net exports, it was actually grew by less than population growth. So there is a little bit of weakness there. Now, if we go to the next chart, you'll see that there's actually been... So what I've done here is I've actually tracked real domestic per capita final demand. So that's final demand in real terms minus population growth over a long period. And as you can see there, we've actually had basically zero growth since June 2012.
It's been pretty flat.
Yeah, very flat. So basically we've had 7.5 years where per capita demand in the economy, so the per capita economy hasn't grown.
Yep. So
once you exclude net exports out of there.
Right. Yep.
So that's actually a pretty poor result. And just to break that down further, if we go on to the next chart, I've done the annual growth rate in trend terms, breaking it out between the public sector and the private sector. So what I've done here is I've summed household final consumption expenditure and private investment against government final consumption expenditure and government investment. Mm-hmm. And what this actually shows is that in 2019 we had zero growth in private demand. Right. So the private economy, the private sector economy, had experienced zero growth in 2019, and all the growth in the Australian economy was from government spending. So
ScoMo's surplus isn't looking great. Is that the
not really. But basically, what happened was, as we all probably know, the federal government's got has had two massive government programs running: the NDIS rollout, which is about $22 billion a year, as well as the National Broadband Network, which is $51 billion. Now, both those things have been ramping up over the last few years, but here's the catch. They're both supposed to finish the rollout by June this year.
Wow. Okay.
So this is basically the last vestige of the boom in public spending. And just to highlight the point, public spending grew by 5.3% in 2019, again against private spending, which was zero. Private demand, which is zero. So the economy is basically on public sector life support at the moment. Well, it was as of December, which isn't a great picture to paint. It does sort of show a lot of underlying weakness.
Yep.
And just to highlight the underlying weakness even further, there's also, as we know, wages haven't been growing much, if at all. And the National Accounts provides us with another figure which is pretty useful, and that's real average compensation per employee. So what it basically looks at is total employee compensation across the economy divided by number of workers.
Yep.
And once you adjust for inflation, it did rise a little bit in 2019, but once you adjust for inflation, it's actually fallen by 2.2% since March 2012.
Which was the peak.
That's right, which was the peak. So basically, we've got this, just like domestic demand, household incomes are basically stagnating as well, and they have for at least 7 years.
And this, to me, comes back to why we've obviously had a relatively restless voting population, and we keep going through different prime ministers and all that type of stuff. And to me, this is a big part of the reason why it's pretty hard to tell everyone, hey, we've got the greatest economy ever, and we obviously have ScoMo and Frydenberg trying to spruik it up at all times, telling us how great and how fantastic our economy is. But if people aren't feeling it in their own hip pocket, then it's pretty easy to see why they're sort of saying, well, just a minute, if the economy is so great, how come I'm not doing well? Somebody must be the other guy. I'm getting mad. And it is. Yeah. It's the companies that are doing well.
And to Damien's point, the IMF released global economic forecasts in December, and obviously with the coronavirus and everything, it's probably changed. But the IMF actually predicted that Australia was going to have the strongest GDP growth in 2020 out of advanced nations, but the weakest per capita GDP growth across developed nations.
That's the rub.
Yeah, so obviously, the aggregate economy is going quite strong. Well, it's quite soft, but it's going relatively well, I guess, because we've got very high population growth, which is 2.5 times the OECD average. But once you strip out that population growth, there's not a lot of, it's got a very weak underbelly. We've got stagnating income, stagnating private demand, and final demand. So
and so it's good for companies, because companies, if you've got your grocery shop on the corner, and they're putting up buildings all around you, then there's just more people to come to your shop, and it's you need a lot more before somebody sticks up a new one. And so you do get the companies, big benefit for companies, but as it slows down, and also arguably some of the companies are reliant on this whole population. Well, probably not even arguably. There's a lot of companies reliant on the whole population to keep on going. So
growth by any means, I guess, at the end of the day.
So if you do get a slowdown and something like a global pandemic, generally you would expect that would actually slow down immigration.
Although it's not slowing down things leaving cold shelves at the moment. But
no, that's right, especially not toilet paper. So, but yeah, that's that. Then if your whole business model is predicated on having more people come into the country all the time, then you might be in for a tough few months until it's over and they start cranking the immigration machine back up again.
Yep, no, fair point.
But this is actually a great segue into the next slide, which actually measures labour productivity. So the national accounts gives you real GDP per hour worked, which is the common measure of how productive labour is.
Yep.
And basically, this gets back to Damien's point and my point that the economy's basically been run on having more people because labour productivity has had zero increase in 3 years. So we're basically bringing in more people, we've got more workers, there's more whirling widgets. Yep. More people coming in, more people consuming, etc., which boosts aggregate growth.
Yep.
But once you strip out that population growth, we've got no productivity increase. Which then explains why wages aren't increasing.
Yep.
Why per capita final demand's not increasing. So it's kind of a bit of a fake. I've called it previously the rat wheel economy, where it spins but doesn't go anywhere when you're the individual inside the rat wheel.
Yep.
So anyway, but moving on to the next point, Australia's been pretty fortunate in some ways in the last 3 years because we've had a big spike in the terms of trade. So what the terms of trade is it's basically Australia's export prices relative to import prices. So when commodity prices rise, which they have in the last 3 years, principally because there was a flood in Brazil which knocked out their iron ore, and it set the iron ore price rocketing because it knocked out a large chunk of global supply.
Yep.
What that did was it pushed up iron ore prices, and then that increased Australia's terms of trade, so our export prices relative to our import prices by 30% since March 2016. And what that does is it effectively gave the nation a pay rise because we sell the rest of the world commodities, we buy other stuff, whatever it is, and we basically got a pay rise in what we sell to the rest of the world.
Yep.
And that helped to lift national income. But what we saw in the December quarter is that the terms of trade started to fall. For a lot of reasons, weakness in China and going forward, Brazil's iron ore is going to come back online.
Yep.
And what they did, if we skip across to the next chart, is the chart on the left shows that there's a very high correlation between the national disposable income. So that's income of companies, income of households, basically combined. There's a very high correlation between the terms of trade and that's the link. That's really the link for company profits. So when commodity prices,
resource company profits.
Yeah, that's right. Yeah, resource company profits, but also feeds into the government budget because they collect company tax, obviously. So we had a decent spike in national income. Of course, it didn't go to workers, but it went to mining companies. But now that the terms of trade starting to fall, and we expect it's going to fall it's going to fall right back. National income is going to be under pressure, which means also the government budget is going to be under pressure. And it could also feed into lower wage growth at the margin as well, even though the increase didn't really feed much into it.
Yeah. I mean, part of it for me, I look at that second chart, the one on the right there, and basically for people not watching, people listening in rather than watching, there's basically a 45-degree-ish line. It's actually probably trending down a little bit more now, which is the
real
GDP
per capita.
And then you've got your the one which includes which doesn't include the prices, and then you've got the one that does include the prices, and you can see that sort of left the trend and jumped much higher than that over the last few years. Is that this is one of those ones where, well, if you expect prices to always go higher for commodities, then yes, it'll stay higher.
Yep.
But if you expect that there's mean reversion and commodities in the past, commodities have been around for a long time, and you generally do get
boom bust.
Boom bust, but you also get deflation in a lot of these commodities over long periods of time. Is that could easily spend some time underneath that line as well?
Wow!
As you see, commodity prices come back down over in the longer term.
Yeah. So the upshot is
actually in the short term at the moment with coronavirus, but
yeah, that's right. So the upshot is though next few years, like we expect real GDP per capita is going to be weak. It's going to continue to be weak, but this national disposable income is going to be even weaker because you're going to get that mean reversion with commodity prices and the terms of trade falling.
Yep.
So it's a pretty sober picture, and I'll say that all this data predates obviously the coronavirus, predates the bushfires.
That's right.
Because it's only the December quarter. So if we slide on to the next chart, I just want to give a little bit of a wrap up here on this stuff. But so the Australian economy was pretty weak pre-bushfires and the coronavirus. So before these things hit in our annual report, we expected 2020 to be a pretty bad year anyway, principally because there's been a huge collapse in dwelling approvals. And so that means that we're looking at probably 18 months to 2 years of falling housing construction.
Yep.
And construction jobs count for about 9% of total jobs.
Wow.
So we're expecting a pretty big hit to growth there. On top of that, as I mentioned earlier, both the NDIS and the National Broadband Network are due to finish their rollouts mid-year, which means that in the second half, obviously, we're not going to get that contribution from growth. So the government spending growth was going to fall off a cliff
anyway. Yeah, sure.
At the same time as private investment, private demand because of the dwelling construction crash, and among other things, is also very weak. But now we've got to obviously factor in the coronavirus, which is obviously rampaging across the world, and
bushfires as well.
Of course, yeah.
Could have hit us even before that.
Yeah, that's right. Yeah. So we had bushfires obviously in the first half of the first quarter, and that's going to have impacts going forward.
And the crimp there was mainly on the tourism side.
Yeah, that's right.
As opposed to the real economy in terms of amount burnt and all that type of stuff. Makes a little bit of a difference, but it wasn't nowhere near as devastating as the amount of ecological damage and things like that are done.
Yeah,
it's more the blow to tourism is where it really hits the pocket.
Yep.
Yeah, and perversely, this is why I hate GDP as a measure so much. The bushfire, like natural disasters, take away from growth initially, but then they actually add to growth later because you've got to rebuild what you lost.
Broken window.
Yeah, that's right. So it's basically it's like digging a hole and filling it up again.
Yep.
You end up in the same spot.
Yep.
But you end up getting this growth.
Not from a GDP perspective.
Yeah, that's right.
You end up well in front.
That's right, which is why I hate GDP as a measure. But anyway, the bigger one, in my view, and probably Damien's view, is the coronavirus. So obviously we've got the coronavirus. The situation is getting worse. It's spreading to more countries. It's impacting especially Australia's big Australian partner in China, which we have links with. Everything basically, commodities. You know what we've got: commodities, tourism, education, are probably the big three.
Property as well.
Yeah, property as well. Yeah. So as I said, Australia was already facing a pretty bad 2020 with like lower growth and whatever. But now I think we're legitimately staring down the barrel of our first official recession in nearly 30 years because, I expect the March quarter national accounts, because of the bushfires and obviously the coronavirus, will be negative, and probably June as well.
Yep.
And that's pretty unusual in Australia, because it's not because we've got this great economy, it's because we've got very high population growth. So for Australia to have an official recession, we've actually got to go backwards more than 1.5% per capita, which is because that's our growth rate. That's our population growth rate. So
okay. Over one or 2 quarters? How many quarters?
So official recession, you could have 2 consecutive quarters of negative economic growth in aggregate.
Yep.
But because of Australia's high population growth, it actually makes that quite hard to do.
Yeah, sure.
But I think we're actually going to get there this time.
Wow. Yeah.
Because of obviously the coronavirus and the bushfire impact. So 2020 was already going to be pretty bad, and now I think it's going to be terrible. Not just in Australia, but globally as well, obviously. Yep. So yeah, it's a pretty so that's why we named this the calm before the storm.
So predicted Q1 and Q2 you feel this year for that to happen? Yep.
Yeah, I think both are going to have negative prints. Of course it could be wrong. We could get lucky again, but I think also with the fact that we had an inventory build up in the December quarter, which usually goes up one quarter, down the next, so it adds to growth, drags to growth.
Okay.
That's likely to probably drag next quarter.
Yep.
The March quarter. Which will be a headwind as well. So I wouldn't be surprised if we've got 2 consecutive quarters in official recession.
Now this isn't something that I, not a theory I espouse to, but there's certainly a lot out there who basically just say that China's about to launch the world's biggest ever construction binge, even though, well, they're already having the world's biggest ever construction binge.
They don't want 5 years.
They're about to double the size of it to keep everything going, and that's going to make iron ore boom and everything else that Australia does boom, and we're going to be a net beneficiary of the whole thing, and so quickly buy now before before they start. So I might So I've got my own thoughts about that, but I'll punt it across to you first to see what your thoughts are on that view.
Yeah, I don't see China's basically in lockdown, so I don't know how they're going to suddenly get everyone out and about
And there's no
building stuff.
And the ability, they can't turn it on a dime anyway. I guess they can say to markets, okay, we're going to double our amount of spending, but if it actually, when's it actually come through to the economy?
Well, I mean, I guess it is possible they could just build about 100 hospitals because they need it. I mean, I don't know.
They can't build any more airports because they didn't need any more airports before this started, and so your capacity's not going to need any more after it.
Yeah. I mean, maybe that's possible. I think it's pretty unlikely, just because the whole place seems to be at a standstill at the moment. So they'd have to turn around pretty quick, and they have to suddenly get people out and about and let them roam free and potentially spread the virus. So.
Yeah, I mean, I guess from on the plus side, I think generally within construction, there's probably less, versus an office environment, at least the construction, they're outdoors and a bit more fresh air and all that type of stuff. I think it's less spreading than us sitting around an office coughing at each other.
That's true.
But I guess the main thing for me is that the premiers and I think it's probably Lee came out in sort of 2008 saying about how unbalanced the economy was over there and about how they were way too dependent upon building and all that type of stuff. And since then, they've tripled the amount of building they're doing. And there's fewer people moving into cities. So at that time, there's sort of like close to 25 million people moving into cities per year.
Yep.
And now it's back to sort of 22 or 21. It's like it's gradually coming down. So there's fewer people moving into cities, and they're building 3 times as much.
Yep.
And then you're saying now from building 3 times as much as what they were when they were already unbalanced, they're now going to go and double that again or whatever. And so I think, and they've made noises about the Chinese authorities made noises about it not being as construction heavy and all that type of stuff this time around. But
what else are they going to do?
Yeah, exactly. That's the problem is they know which lever to pull.
Yep.
And they're not quite sure what other levers they can pull.
And
so it's not going to be the retail. In my view, you don't sit in a quarantine and have a lockdown for weeks and months, and then all of a sudden, once you get out of that, rush out and think, I really need that Louis Vuitton handbag, or I need the discretionary items. You're thinking more about maybe I'll save my money and I'll stockpile a few more things and
or try and get out of China for the next one.
Yeah, that's right.
That's also just highlights the problem with growth economics as well. So for example, I'm just pulling this figure out of the air. But if China, say, builds $1 trillion worth of infrastructure one year, they have to build more than $1 trillion next year to have growth.
That's right.
So even if they build 950 billion, even though it's a big number, and you go, they're still building heaps.
Yep.
If it's not bigger than the year before, they go backwards.
They're contracting.
So which is this whole thing that Damien said, like they're building 3 times as much as they did back then. Yep. Well, now they've got to build 3 times plus. Or plus X to have growth.
And the other factor is services are not quite the same as manufacturing, in that if there are back orders, if you're on back order for parts for cars, for example, or for parts for widgets, iPhones and things like that, quite often there will be a catch up within that, and they'll sort of they'll run their factories at double capacity or do whatever they can do to actually get a catch up. And so while they lose some revenue, they do actually often pick that back up again.
Yeah, right.
The issue though is that so much more of the economy is now services, and so if let's say you've missed out on some education.
You can't do 2 lots of education to pick it back up again.
Exactly, you don't spend the money, or you haven't done your holiday that you're going to do.
Yep.
You don't go and have 2 holidays back to back
make it up.
to make up for it, or if you haven't watched movies for 6 weeks.
Yep.
Right, and you watched it once a week. It's not like you're going to rush out and watch a movie every night of the week now.
Yeah, sure.
So there are those factors with services where often the services is once it's gone, it's just gone.
Yeah,
it's not coming back.
Yep.
It's there might be a slight pickup, but it's nowhere near the lost capacity. Whereas manufacturing can often you can have
soak
that
up
catch
some
up.
of that. Yeah,
because it's basically lost time.
Yep. We might just turn the view to the local soil in terms of stimulus. We've spoken about China's big money wave. Do you think that Australia might need to or possibly could, and in what way they might be able to release the spigots?
Foreshadowed it's coming in the next couple of days. We'll find out.
By way of what the budget estimates or
Escobar's already said he's going to come out with something. It's going to be it's gone
investment
from,
allowance.
Initially, he was talking about modest, but I think he's dropped the word modest. It's now going to be targeted and measured, I think is the word he's using, and a few other bits and pieces. So he's already ruled out some infrastructure because it'll take too long to get up and running.
Well, I was about to say, I drove in here just then, and I don't think I drove on a bit of road that wasn't under roadworks. So I'm not sure if you could actually create more infrastructure roadworks, coming from the west.
Honestly, if I was the government, I'd be immediately lifting New Start. That'd be probably. It makes sense from a
humanitarian?
humanitarian equity perspective, but also it makes perfect economic sense because the unemployed are obviously they'll spend virtually every dollar they get.
100%, yeah.
Every dollar they get. So if you want to have an instant hit, do that. Don't do tax cuts. Don't do investment allowances. That's what they're looking at. They were talking about doing investment allowance because.
Just explain investment.
Investment allowance, basically like accelerated depreciation and stuff like that.
Oh, right.
Which, you might have your view on whether that's good policy or not, but from a stimulus point of view, when your economy's got a deficit of demand, the last thing you want to do is actually increase supply.
Yep.
Yeah. You got to
and it's the part about companies who are operating at 80% capacity or 70% capacity, so they've already got all this extra slack.
Yeah, you don't need to give more slack.
Hey, Leith, would you like to go build another factory? And it's like, well, no, I can't even fill the one I've got. So
that's it.
Fill that up first. So you're giving me a thing so I can go and build another factory and then be at 50% capacity is just not...
Doesn't make economic sense, does it?
Yeah, so we've got this demand hole, so you're better off trying to fill the demand hole, and I think the best way to do it would be to lift New Start and do it. They could do it potentially very quickly.
Yep.
Just announce it, do it. They get cross-bench support because pretty much everyone in the economy, cross-section, whether it's conservative, whatever, left, just about everyone, the business council thinks it's a good idea.
Yep.
And it's something they should have done years ago, and it's
been flat as you
indicated. So basically, New Start's fallen 30% below the poverty line. It hasn't increased in real terms since really the last recession about 30 years ago.
Wow!
At the same time as everything else has gone up, the age pension. So everything. So that's what they should do. Hopefully
they do it. Yeah. Because the issue, as you said, is that they've been very reluctant to do stuff on that, and there's a bit of a they've sort of painted themselves a little bit into the corner in terms of saying no, they don't deserve it, and type factors, and these people should find jobs. That type of attitude to it, which I think hopefully they will do flip around. But as you said, I could easily see though as well. They come out and say, well, let's do a few more credits for tradies to buy utes and blah 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 blah. And it's like going, these guys who are now out of work or whatever aren't going to rush out and buy new tools for those types of things, and we've played that card a few times over the last few years.
Absolutely.
So they're good to have those ones every now and again, but we've just sort of gone back and gone, keep playing that same card, and each time you play it, there's just less and less of an effect you get.
Diminishing effect.
So I'm just trying to think what else. So outside of lifting New Start, I'm just trying to think what else would actually.
You could always do the old Ken Henry cash for households thing, but
Kevin 07.
Sorry, when I say that,
helicopter drop.
What are the positive ones we consider? Yes, so that, but they've been so vehement against that, and what a bad idea it is. Again, that doesn't seem likely that'll be the case. We're positive they'll come out with a bunch of housing. Things like that's one.
Absolutely, I'd almost stake my claim on the fact they're going to boost the first home buyer subsidy, because basically they had 10,000 spots for the first 6 months, 10,000 spots for the second 6 months. The first 10,000 got filled in 2 months.
Wow. Okay.
So it's incredibly popular, vote winner.
Yep.
I think they'll do that for sure.
But I've been saying that the stock market, a month ago, we panicked and went, this thing's coming. Let's go to cash and all that sort of stuff, and then we did, and then the stock market kept rising. We're sort of like, just a minute, we've got what's happening? Is this surely everyone's seeing the same data we're seeing, and surely that's, and it's that Wile E. Coyote moment where he's, for any of the younger viewers who haven't seen the Roadrunner, he runs off a cliff and his feet keep spinning and he stands in the air and then
has to think about it
before he finally drops and hits the ground, and that was the stock markets sitting there running along in midair, oblivious to what was happening. I'm just wondering whether the housing market is in that. Well, I think the housing market is definitely in that state at the moment. The auction clearances on the weekend were still quite strong, and so we're still still in that point. But
first home buyers.
The question now is saying how much firepower can they throw at it?
Yep.
And the Australian government has very low debt relative to the rest of the world. So if there's I can't think why you would possibly want to waste all that on propping up the housing market. But it is entirely possible that they just throw far more than we could ever consider. You know, you talk about the joke is the other some of the other central banks, like the Japanese central bank has run out of things to buy, run out of government bonds to buy, and so they're actually buying equities. They buy exchange traded funds. There are some exchange traded funds where the Japanese government owns like 70% of all of the stock on the market within that exchange traded fund. Because they're just buying incredible amounts. The joke is, well, we need to get the RBA, point the RBA at the housing market and get them to go out and buy houses. But effectively, it might be won't be a direct one.
No.
But if our expectation is it'll probably be way bigger than it should be, just because there is this ideological factor, and one of the promises from the election was you'll have higher house prices under the Morrison government.
Yep.
Now, having said all that, it's still in that binary situation where, in my view, if it doesn't hold, if he doesn't throw enough at it, and I'm a bit scared about saying it just in case it gets back to him that he needs to throw more at it, but if it doesn't throw enough at it, then you will see that house price fall away and fall sharply.
Yep.
The Spanish housing market crash didn't finish because the Spanish government really wanted it to go down. They wanted everything to keep going. The Irish one didn't finish because they wanted it to go down. The US one didn't finish because the government there decided they'd had enough of high house prices. These things happen because you reach the end of the cycle, people are too geared, prices are too high, and they need to be reset. And if you don't get a big stimulus, then that's what our expectation is. That's where you're going.
Yep.
And the only thing stopping us, if you had a normal government in there, I'd say, odds are that property prices are going to fall and fall quite a lot.
Yep.
We just don't know what they're going to throw at it. So
it's a good point.
Yeah, I mean, it certainly wouldn't over the longer term. It doesn't make it any better, the fact they prop up houses for a little bit.
Yep.
But the other thing as well is, we've already shot all our bullets, trying to hold things just where they are.
Yeah.
What you mean by the Reserve Bank?
Reserve Bank.
Yep.
Yeah. So the RBA in terms of rate cuts and
APRA loosening the
lending standards.
lending standards.
All these, and we spoke about this. God knows how many times we've spoken about this in podcasts about saying the real danger for Australia is an external shock, because we're doing everything we can to hold these house prices at a high level, just so that we can get voted in one more time. And so if you do get an external shock, then look out. And we have an external shock.
Yep.
Yeah. So as I said, to me, the real thing for anyone on the housing side is there will be policies from the Morrison government, but I think, to me, if it's a first home buyer, we're doubling the number of people who can get it. That's not going to do it.
It won't. They're not. They're just not big enough.
It's going to have to be something big that you sort of 5-10% of GDP effectively gets sucked in more into the housing market for whatever it is. Government.
Some more stilts, some government stilts underneath. So
So look, hopefully it won't happen, because I do think that type of having a government spend all its budget on trying to prop up an overpriced market,
massive malinvestment.
Is just incredibly bad from so many different angles. But it could easily happen.
Especially when they can be putting the money again into better things like lifting Newstart, which should have happened.
Spending on something substantial rather than asset prices.
Yeah, and the fact that he's already ruled out the infrastructure side is a bit sad for me as well. Last time this happened during the financial crisis, the whole thing was saying we need shovel-ready projects so that next time this happens, they're there ready to go. They've been, we've already done the surveys, we've already done the checks and all that type of stuff like that. There's not like a year-long process of getting approvals and checking, doing the plans and all that type of stuff. We've got shovel-ready projects that we can go. And here we are.
On the precipice,
the next crisis, and we're saying, well, no, sorry, we can't get them going fast.
And money's so cheap too.
Yeah,
you can borrow it. What is it now? 1.5%.
The government 10-year bonds. Sub 1%.
Oh wow. Okay.
So inflation is 1.6 or whatever.
Yep.
So
1.7. Yeah.
You can in real terms, the government is borrowing at negative rates.
Yeah. So why wouldn't you?
If all it did was got inflation, it is making money on this deal.
Yeah, sure.
And so the obvious thing to do is to just to load up, and the obvious thing to do is to have done exactly what we said we needed to do last time, have all these shovel-ready projects, and then start throwing it in. And as you said, new start.
Yep.
So it's the most obvious.
So you got the short-term stimulus, and you got the slightly medium to long, because obviously infrastructure takes much longer lead time. But but the new start one for me is just a no-brainer.
Yeah.
You got to do it.
So the more we see that type of stuff, the more you'll think, this won't get as bad.
Yep.
The more it turns into let's try and prop the housing market up, or let's try and give tax credits here, or investment
tax cuts.
Tax cuts,
Whatever
whatever.
the 1%ers.
Yeah. Look, honestly, bringing forward the legislative tax cuts would be absolutely crazy, because we saw what happened last year. So last year the tax cuts were targeted more towards the middle end rather than the higher end.
Yep.
And even then, the savings rate spiked just for one quarter in September quarter.
Interesting.
When it came in. So households basically just saved it. They didn't spend it.
Yeah.
Now the savings rate in the December quarter national accounts went back down again because that filtered through. But all that's going to happen is if you give tax cuts to the higher end, it's going to be saved.
Goes on the pile.
Whereas if you cut New Start, raise New Start,
and especially now when
gets spent.
It's the people at the higher end who are going to own the shares and they're going to own the houses, and they're the people who are going to be feeling, I've just lost all this money on whatever.
I'm not going to spend.
I'm not going to get out and spend it. I've just got a bit of extra cash. Great, that's going to try and offset some of the losses I just made on my investment portfolio.
Oh, and speaking of shovel-ready projects, we might see that fast rail to Sydney resurfacing again at some point. But anyway, I say that in jest.
Yeah, but
Please
the
don't do
reality
that,
for that one is,
please don't do that.
Yeah. But the reality for that one though is, like, if you'd planned it and you had it all laid out, then you could start it.
Yeah,
absolutely.
Yeah.
It might cost you 50 billion or 100 billion or something like that, but you could actually start on that, and regardless of how bad Leith, I won't even get Leith started on how bad he thinks it is. It would be creating jobs,
something
helping the rest of it, and would be marginally positive. If you could borrow less than 1%.
Yeah. That's right.
But if you turned it on today, you got like years of buying land and doing surveys and testing things and all that, and there's a bit of spend in that, but you can't actually do the really big spend until the whole thing's planned.
Yeah, that's right.
And so by the time that money's being spent, that's shut the gate.
And we're not close enough to an election anyway to talk about the fast rail. So that's how I know when election's coming. I just start hearing about fast rail to Sydney. Anyway, we better move on.
Yep.
So investment implications, we've got reflexivity. Damien.
Yeah, so and we've sort of been talking about that already. I mean, the key thing for this now is it's what the central bank does and it's what the government does. So we think we know where the path is. The path is certainly downwards, in terms of if nothing happens, Australia is in for a big shock.
Yep.
And recessionary, and if you didn't do anything, possibly depressionary.
Yep, sure.
So, but that's assuming nothing else happens. But now we need to see what is the impact. So, the effect of the government. And all those things we just spoke about then, that's the biggest factor. The RBA is out of bullets.
Yep.
And as well, it's just been shown up in terms of saying, here they are coming out and saying, 25 basis points aren't we good? And here's the US having an emergency meeting and knocking 50 off.
Yeah.
And so, the Australian wording was sort of along the lines of, it seems like something bad's happening overseas and maybe we better better get in a little bit of insurance cut and everything will be fine. Whereas the US is in panic mode. We can't even wait for our next meeting. We've got to get it in now.
Yeah, right.
And so the benefit of having a lower dollar is is helping the Australian tradable industries and helping save those jobs or create new ones.
Yep.
And the US is basically saying, no, we're prepared to do more than you. We're prepared to get out and really push this. So getting those cuts in quickly and getting to quantitative easing. But the reality is we've seen from everywhere else, central banks can't solve this.
Yep.
They can help, and they can help things not get critically bad.
Yep.
But they can't.
They're not the magic antidote.
They can't print demand.
Yeah.
No, you need fiscal policy.
Governments can get out and spend money and create demand. As you said, increasing New Start. increases demand because every single person who gets it is going to get out and
They
spend
could have it by Thursday if they wanted to.
Exactly.
Isn't that pension day? I'm not sure. Anyway.
Yeah.
I mean, it can be done very quickly. As you said, Tim, you could have an impact in a fortnight.
Yeah.
It's very quick. Oh, even less than a fortnight if the next payment's.
Yeah.
But we don't think it really matters that much. If let's say they tripled the R&D
the
plan or something, or grant, or things like that,
it's all lagging stuff.
That's stuff where even companies who go, oh, that's great, I will do that, now need to plan.
Yep.
So they then now sit there and go, oh, okay, I'd like to get that. Over the next 2 or 3 months, we'll work out what we're going to do it, and then we'll take, then we'll apply and we'll go through the process, and in 6 months' time, we'll start the projects to start spending that. And it's like, well, no, you need the money. If you want it going, you need it now.
You can have board meetings, investment meetings, blah blah blah.
Yep. Fair enough.
So that side of reflexivity is is that the corporate debt market is one of the key ones at the moment. So this is probably coming more back to the coronavirus side than the economy side. But really at the moment the corporate debt market is shut down. So if we don't see that come back online, meaningfully come back online, then doesn't matter how cheap your credit gets. How cheap your government bonds get.
Yep.
If corporate debt is getting more expensive, and it is, and it's not even being, anyone who's slightly questionable isn't getting any money, then that's going to create a much bigger problem. Consumers, seeing what consumers do, I think the big benefit for Australia is it does look at the moment to us as if it's a winter-summer, there's a winter-summer thing.
Yep.
So if it does hit Australia, it will likely be less than what we're seeing overseas at the moment. But the flip side is, by the time they're all in 3 months' time, when everyone else is starting to get over it and starting to forget about it and think about what the next thing they're doing, could easily be the time it's hitting Australia. And that's not going to be good for tourism again and other factors. We think companies are basically going to be shifting their supply chains out of China and really frozen, I think, for the most part, because they don't know what's happening.
Yep.
And so when you don't know what's happening as a company, you don't rush out and spend on capex. And we saw in this latest accounts, capex was down.
Yep.
What was it?
It was down a lot. I think
was it
3 point something. I can't remember.
But
it was a lot.
It was a 0.5 drag on the economy, was it, or something? Yeah. Anyway.
Yeah.
There's a big
no,
drag.
No, it was 0.2. 0.2 private investment.
Big drag on GDP growth.
Yep.
Companies are not rushing out there to spend more money in this type of environment.
No.
Yeah. So so this reflexivity is all about saying, with nothing else happening, there's absolutely terrible outcomes, but we know things are going to happen. Now it's just a question of trying to work out, are these things that are actually going to help, or are they just things that are going to seem like they're going to help?
Yep.
So cutting rates to us at this point of the cycle doesn't really matter.
Yeah, okay.
You just want to get the Aussie dollar down.
Yep.
But X that, yeah. So.
Sure. Okay. We'll jump across to where we've felt that the expectations were and where we are now.
Yeah, that's just so from where. So say a month ago, we just expected bonds to get bid, Aussie dollar down, commodities down, stocks down, and that's obviously all coming through. We're not rushing out and buying anything at the moment.
Yep.
We're certainly looking at there's stocks. There's a lot within our portfolios. There's stocks that are getting hit a lot harder. Stocks on the market, there's stocks that are getting hit a lot harder and stocks aren't getting hit, and we're sort of we've got a lot of stocks in our portfolio that are very defensive.
Yep.
And now we're trying to work out, do we try and switch some of those around, and where do we look for real quality bargains, especially where we can trade up. That's probably the biggest thing we're trying to do. So we're not trying to buy more equities at the moment, but we are looking where we can trade up and say, okay, here's a company that's just had a profit warning and fallen 15% that we don't own.
Yep.
Here's a company in the same sector with similar characteristics that hasn't yet profit warned. Maybe we can switch out of one and into the other, and
obviously good quality companies.
As long as similar quality and all that type of stuff, and sort of before the second company puts its profit warning in and sees a similar fall. So that type of thing where it's more of a relative game at this point. But we're huddled in cash and bonds as we've been for a month or so now, and really just looking to. So, I think we'll have our results out sort of in the next week or so, but we, all our portfolios, all our tactical portfolios are up, except for the growth portfolio, which I think was basically flat on the month. In that environment, we're quite fortunate. We've got a big war chest, and we want to deploy it at some stage, but it's just far too early in our view to actually get out and start buying it.
Yeah, sure. Okay, very good. And we'll look forward to that performance report as well. Fantastic. All right. Well, thank you, gents. Terrific show. And I really look forward to Q1 2020 national accounts to see exactly what the fallout's going to look like. So on that note, next week, so on the 12th of March, same bat time, same bat channel, 12:30 p.m. Australian Eastern Time, we have Salvatore Balbones, who is an author and political sociologist at the University of Sydney and is an elected member of the National Committee on US-China Relations. And he's coming along to discuss the potential impact of the coronavirus on the Australian economy. So stay tuned for that one. It's going to be a fantastic chat, and we'll be putting that one out next Thursday. We'll see you there. Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return, we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers.